What's up, everybody? Today we're talking about Nvidia. They came out last week, I think it was, pre-announced Q2 earnings. The stock dropped. It's down 40% year to date still. It's recovered a little bit since then. I'm going to share some things with you why I'm still not buying the stock, and I am going to actually share, I like the stock. I want to own the stock. It's just too expensive given its historical PE and price sales ratio and then their future expectations. And I'm gonna give you the price that I would actually consider buying shares at. All right, first of all, if you have watched this channel at all, you know that I am building a $1 million portfolio right here on YouTube transparently. We started it at $10,000 on February 15th. I have added money over time. We've added $86,960. It's currently worth $94,520, which means we are up $7,600. We were down for a long time, but now we've come back. Today, portfolio is down $1,800, so not a good day, but that happens. Here are the companies I own, and again, I don't want anybody to just follow me. I share this because I want you to see the companies I own, how they're actually performing. So it tells you if you should even listen to anything I say whatsoever, but never by any means do I think anybody should just follow somebody into companies. I try to share research and my thoughts, and I share my portfolio for transparency. So you know if I'm talking about a stock, if I own it or not. If you like that transparency, do me a favor, like the video and subscribe to the channel. Helps more people find us, and make sure you never miss an update. Hit that notification bell so you get notified when I release a video. GTLab is a company, it's actually my second largest position right now. Very risky. They report earnings this afternoon, so probably tomorrow I'm gonna post a video covering GTLab's earnings, and I'll either be sad or happy. We'll see how it goes. Let me know in the comments if you own GTLab and what you think of earnings once they post. Anyways, we're talking about Nvidia, right? So they came out and they lowered their quarterly sales expectations, right? And so that's reflected here in the upcoming quarter's earnings estimates. You can see that they have had 21 EPS revisions down over the last 90 days. That's because analysts came in and they updated expectations based on the updated Q2 numbers or quarterly numbers that management just provided. Okay, that's why this is so bad. So this is what they're expecting right now. Adjusted EPS of 50 cents, which is down huge from last quarter. Last quarter they had $1.36. GAAP EPS of 18 cents, down huge from 64 cents. And then the revenue expectation is 6.7 billion, down from 8.29. It's trading at a FY23 forward PE of 48. If you got to 24, forward PE of 32, that's pretty high. FY23 forward price sales ratio 15, forward price sales of FY24 of 12. And so what I like to do is I like to come and look at fast graphs, and I like to look at where the stock has traded historically. We can see here, this blue line represents a normalized price to earnings ratio of 33. Right now it's traded at a blended PE of 42, which is far above its normalized PE of 33. That's normalized in terms of that's been the average since 2002. But in my opinion, their average is actually inflated. So we need to take out post-COVID, because I don't think post-COVID is a realistic scenario to think about what the normalized PE ratio should be since it got so elevated. So if we just take out post-COVID, that brings the PE ratio down to 31, which is even a little bit lower. And then if we want to go, really since like from 2010 to 2019, then we're really looking at a normalized PE ratio of 29. But the key thing we got to look at, their earnings growth rate has been 43% over that time. So that's a normalized PE of 29 with 43% average annual earnings growth. If that average annual earnings growth is going to be lower in the future, the stock probably does not deserve to trade at the same type of PE multiple. So we've got a couple things working against us. Slowing earnings growth, a PE that's already over its historical average, and the fact that when earnings growth was actually faster, it traded at a lower multiple. So there's a lot of risks to the multiple, in my opinion. So what we can do is we can go to forecast, and we can use, even if we use 30 as the baseline, right? Let's go to forecasting, and we're gonna go to custom here. We're gonna put in estimates, which puts in the analyst expectations through 2025 is for 17%. And I'll be generous, and I'll even put 20% in for FY26 to 28. and we'll see how this goes, right? And so if we remember, the kind of average PE we said was around 30. If the average PE is 30 and it gets back to that average, we'll look out through 2025, which is about 2 years from now. So if it goes down to that average PE of 30, we're looking at a 2% annualized rate of return. If it's somehow able to stay up at 42, then you get quite a nice return of 17%. I personally do not think that that is a realistic expectations given the fact that their earnings growth is expected to slow drastically. I know there's a lot of big Nvidia bulls out there, and I like the company again, but they are not going to grow revenue or earnings as fast as they historically have, simply because of the law of large numbers, and it's harder to grow at the same rate when you're dealing with bigger numbers. Simple fact. If you look at any company over any sustainable period of time, that's the trend, is slower growth, because it's just harder to grow revenue off bigger numbers. So if we go down to 30, again, you got that 2.6% annualized return. But if it trades down, if it's growing at 17% and it trades down to say 24, you're looking at a negative return. If it goes down to a PE of even 27, you're looking at a negative return through 2025. What I want to do here is I did my little fast graphs idea, right? I want to look at a potential 10-year model, and I'm not going to use my own made up numbers. I'm going to base it off kind of analyst expectations out to 2027. And we're going to look at a low scenario, a medium scenario, and a high scenario. How do we get those numbers? Well, if we look at analyst expectations, the compound annual growth rate for revenue from FY 2023 to FY 2027 is 15%. So we're going to use that as kind of our baseline. Okay, and then if we want to get net income margin, which is profit margin, then we can do this here. And in 2027, analysts are expecting 45% net income margin. Okay, so we looked at the revenue growth. It was 15%, and we're using that on the low side, which I think is being pretty generous. 17%, and then 20% on the high side. Profit margin, 43%, 44%, and 45%. Free cash flow, same as profit margin. And then PE, this is where a lot of people might disagree, but if you look at current stocks that are kind of growing in that range right now, the Googles of the world, Facebook, Meta is below this, Microsoft is a little higher, I think Apple's probably a little higher, but I think this is 10 years from now, a realistic baseline for expectations, and people might disagree, and this is what makes the stock market great. But that's what I'm using. And then price free cash flow, 18, 20 to 22. And then 13%, 13%, and 13%. Remember, we're 10 years from now when revenue is going to be a lot bigger, and so future growth potential is going to be lower. That's how, again, law of large numbers works. Let's hit analyze, see what comes out. And so if you believe these numbers, if you believe the low side, the stock is currently overvalued. 162 a share is where you would want to buy it. We're at 179. 207 would be mid if you believe this to be true. 17% revenue growth on average over the next 10 years. Profit margin 44, free cash flow 44, PE of 20. Would be 207. And then 284, if you believe 20% revenue growth, 45% profit margin, 45% free cash flow margin, a PE of 22, and a price free cash flow of 22, and desired annual return of 13%. So that's significant upside. You have to decide. Again, I want to buy this stock. I want to see it come down a little bit. If we jump over to fast graphs again, this is where I would be comfortable buying the stock compared to other opportunities that we have out there. More in line with kind of its normalized historical PE ratio, which would be back down below, on here is at 180 a share. This would be back down to, around 150, 160 a share is where I would start getting more interested in buying Nvidia stock. Again, that's not a huge drop from now, so I am watching it closely, but I still think it's a little too expensive. I think that expectations could come down a little more. And the bottom line is I just like other opportunities out there right now. It's not nearly as overvalued as it was, but I still want this thing to come down a little bit more before I buy shares. Let me know what you think in the comments. Thanks for watching, and have a great day.